afternoon all. My name is Paul Beard and I'm the Managing Director of Avantis Wealth. We're downstairs on stand 33, so if you like what you hear today, I hope you can come downstairs and register with us, or you all should have a registration form that you can just pop in back at the door as you leave. In a 30-second lift pitch for Avantis Wealth, because what we really want to know about today is how to utilise any of your investments in a tax-free environment. But what we do is, I think we're quite unique here today in that Avantis have a fresh investment philosophy. Fresh stands for a fixed return, a rewarding return, and as an investment, it must have an exit strategy. How do you get out of your investment? And because all investments have the capacity for failure, we look for security in the background, and we're looking for the H in fresh to be hands-free. You're not having to monitor the markets and measure volatility always. What makes us unique today in where we are is that we are not using a crystal ball to predict your returns on your investments. They are fixed, they are known, they're contractually obliged. That's interesting, okay? So come down and find out how we do it on stand 33. But I think what is more interesting is some of the partners that we work with. And I'm really pleased to be working alongside Andrew Johnson from Excel Pensions, who work alongside us with a SAS pension scheme. But it's not just a pension scheme. Most people turn off, fall asleep, don't realise how flexible some of the schemes actually are. I'm not going to go into that. I'm going to pass you to Andrew.
Thanks, Paul. Good afternoon, everybody. Hopefully I'm going to take you through a pensions journey, but a very short pensions journey, because I know how pensions are pretty dull, and there's a lot of people who have probably sneaked in to have a quick snooze because they thought they were going to listen to pensions. You are not going to listen to much on pensions. You are going to listen to an awful lot on tax and how to save tax and how to save more tax and even more tax. And I am going to show you what I hope you will agree by the end of this is SAS is probably the best tax product in the UK today, bar none. And it's improved a lot in the last 3 years. But very quickly, we will have a bit of a resume about what SAS is, because it's a fairly unknown product in the UK. And while we're doing that, we will actually take you through a bit of a case study that we've got, and we'll show you how we create wealth and save a lot of tax yet again. So who are we? We are Excel Pensions. We are based up in Nantwich, which is near Crewe, the railway station where every train in the world goes through. Stoke-on-Trent is our nearest biggest town, just to give you some geography. And what we do is we are SAS providers. We hold the bucket. We do the administration, and we are the trustees. So we run it. We don't actually tell you what to put in it. But we work very closely with people like Avantis who provide the investment ideas and advice as to what you can actually do with SAS. But what I'm going to show you is how it works and how you can really get this to work to your advantage. It's fantastic. So very quickly, what is a small self-administered scheme? SAS, most people have never heard of it. Believe it or not, it's actually probably the oldest pension scheme structure in the UK today. SIP has really taken over from SAS. SIP really took over in the late 80s, early 90s as the product of choice for most people, and SAS dwindled in popularity. But it's suddenly come back onto its own. A small self-administered scheme, you have to have a sponsoring employer. So it is a scheme designed for particularly people who run limited companies. It can be an LLP, but most of the stuff we have is run by a limited company because it is a company pension scheme. And this is the difference between SAS and SIP. SIP is individual. You put money into your pot. You invest it with the SIP manager, although the investment choice is fairly narrow these days, unfortunately, due to regulation. But SAS is the company's scheme. So the assets belong to the SAS. And you can have, obviously, more than one member in a SAS, which we'll come on to. So as I said, it's an occupational scheme. And you have to remember that. This is a scheme of the company. It is not your scheme, although you are the beneficiary to the scheme. Must be set up by a sponsoring employer. I'll dispel a myth. Everybody thinks it has to be a limited company. It does not. It can be an LLP. In fact, we had one yesterday, which was a partnership. And the reason a partnership can set up a SAS is because he employs people. Key is in the title. You must have a sponsoring employer. So if you run a partnership and you employ people, you can set one of these up. You can set one of these up if you run an investment company. So we've seen quite an upturn in people coming to us who run property portfolios. So you can set up a SAS alongside your property portfolio company. And you can make contributions even from an investment company. It's an administration expense. So designed for directors and business owners. So you can't do it if you don't have one, I'm afraid. And the rules are getting stricter. The revenue from April, you will have to have an active trading company to go with the SAS. So it must be trading. So when we get a SAS application, we send it off to the revenue, and eventually the revenue will send it back, hopefully, saying it's actually approved, so they are individually approved. So all members are member trustees. The thing with SAS is you are in control. It is a member-directed scheme at the end of the day. So you have complete control. And again, I think that's a big difference to most other pensions that people run, is that they are generally not in control. So you have to make the investment decisions. So what we tend to find is because SAS is an SME, small, medium business type product, the people who run businesses like to make their own decisions. And this is why SAS works so well. Range of investment options, probably the widest range of investment options in any pension in the UK today. Unfortunately, SIPs used to have a wide range of investment options. The clue is always in the title, Self-Invested Personal Pension. Used to be wide. Unfortunately, regulation has really narrowed that, and most of the SIP managers now are not keen on having a wide range of alternative assets. However, I don't have that particular problem because I don't have the FCA breathing down my neck, because SAS is not a regulated pension scheme by the FCA. We are regulated by the pensions regulator and HMRC, so we have more latitude. So you have that latitude to invest in a wider product, and hence the reason we work with someone like Paul, because he does a lot of DD on the products that he allows people to buy, which is what we really, really like. And we can take existing pensions that you have, you can transfer them into a SAS. So I thought I'd run through 5 key things, because clearly I can't cover everything about how SAS works, because I'd be here all day and you'd chuck me out. So I thought we'd run through members' contributions and investments, and then we'd really get on to the exciting bit, which is benefits, and the really exciting bit, which is death. So you never knew you were going to get so excited by death today, but death is really good for SAS. So here we go, members. Who can be a member? Let's dispel some myths. When we used to set SASs up prior to April 2015, because there was a big change in the rules, which I'll go into in a second, SASs quite often were set up by the company, and you would have 2, 3, 4 directors would join the SAS, pool their funds, and typically go and buy the trading premises that they were working from, or they would buy commercial property as a pooled arrangement, or they'd go and buy 1 or 2 other investments. That was the typical arrangement. However, that all changed in April 2015. You can still do it that way, but we now tell everybody to set up SAS effectively as a family wealth trust, because that is what it is. It has become the best family wealth trust you can lay your hands on. It is brilliant. Maximum 11 members. Have family members only, please, because then you can all speak to each other and hopefully all agree. If you're going to do investments, all members of a SAS, they must agree. There must be no dissension. The great thing is, and there's a myth that gets built up with SAS, that the sponsoring employer sets up the SAS, and clearly you will have one of the members will likely be a director employee of that sponsoring employer. Fine. If the director wants to add his, say, spouse to the SAS, That is fine. They do not have to be employed by the sponsoring employer. So actually, you can add anybody you like to a SAS. We even have people who live abroad who are members of a SAS. It's fine. There are no issues. And you will see in a bit why you want to add family members. It is a great plan. So take on your family members and employ them because it allows you to do more in the way of contributions as well. So pretty flexible. Contributions. I could stand here all day on contributions. It is quite complicated, believe it or not. Contributions, we find, are generally made by the sponsoring employer. Any contributions made by the sponsoring employer are usually tax deductible on the company's books. So you are going to save, hopefully, corporation tax currently at the rate of 19%. Obviously, that's going down to 18%, but it's still a good saving for the company. By making contributions from the company, you actually make contributions a little simpler as well, which I'll go into. One of the things I always say to everybody, and I have an accountant friend of mine who always sits in the front row and reminds me of this, so I'll have to remember. One of the things you can also do is you can make personal contributions. There's nothing to stop you putting money in. So if you chuck in, this is the quickest way to get 25% growth on anything, by the way. If you chuck in £2,800 as a net contribution, the revenue will gross that up to £3,600. So you've got 25% growth on an investment before you've even started, which is pretty good. So this is all hugely tax efficient. As you can see, we're driving down a tax road straight away. So contributions, no problem. How much can you contribute? This is a really interesting question and actually a lot more complicated than most people realize. If you're doing a company contribution, then the maximum that the company can contribute for an individual is up to £40,000 in any one tax year. And there is no relation to earnings. So even if you draw a salary of, say, 10 grand and take the rest of your income as dividends, that's absolutely fine. The company can still pay in £40,000 for you. And of course, you do have carry forward relief as well, which I'll go into in a second. So putting contributions in is really good. You can play with it quite a bit more than you think. One of the other things with contributions is most people don't realize, but there's actually no limit to how much you can put in a pension scheme as a contribution. There is only a limit on how much tax relief you can claim. So there are opportunities to play, and you'll see why you want to play. Sorry, that's a bit of a busy slide, but you can put in 40,000, and obviously you have carry forward allowances from the last 3 tax years. So potentially the company, if cash flow can permit and you've got the profits, then quite clearly you can put in £160,000 per member. So we do have quite often a husband and wife SAS scenario, both working for the company. It's quite successful. And usually we get quite often companies chucking in £320,000 of cash and getting tax relief on the whole lot. Pretty good. The contribution to pension is a P&L entry, profit and loss entry. And I have to say, in doing SASs now for the thick end of 10, 12 years, whatever it is, I have never seen the revenue yet challenge a contribution to pension. So that's how, if you like, low risk it is from a tax point of view. That's not to say they can't challenge it, they can. Contributions have to be wholly and exclusively for the purpose of the business. But I've never seen a challenge yet. There's very good reasons why there's case law on it. So, there we go, £160,000 for the director, the tax saving £30,400. Pretty good. Why wouldn't you? Can't think of a reason yet why you wouldn't want to do this. Investments. This is, we don't advise, but this is basically the broad level of investments that you can do, and you can pick up pretty much everything that's on offer today out there. Investments, trusts, bonds, unit trusts, stocks and shares. You can have a stockbroking account if you want with a SAS, and you can ask the stockbroker to pick funds for you. There's a few people who do that. Gold, there seems to be a lot of mineral people out there today. If you want to buy gold bars, we have a couple of clients who own gold bars. So long as it's held in a bonded warehouse, you can hold gold as well. But you can't hold any other precious metal in a SAS, in any pension for that matter. It is only gold, which is surprising. Deposits, third-party loans, loan notes. We are seeing a big uptick in loan notes for third-party loans. So you can lend out of the SAS to a third party for interest. And obviously you can take security. We're seeing a big uptick in this. There's a lot of people doing it. And some of the returns out there are very, very good, particularly if they are security-backed. We like security-backed investments, obviously, because we want to protect you. So big uptick. So very wide range of investments, indeed. Much wider than pretty much any other pension scheme you can lay your hands on. The one we see a lot of is obviously commercial property and land. Very quickly, land, if you have a parcel of land that you want to put in your pension scheme, we're happy to buy land all day long, no problem. Quite a few people put it in with the hope of getting planning permission, because clearly if you buy the land pre-planning and you chuck it in at today's value and you get planning permission for residential development and the land goes from 10 grand to 500 grand in value, then you've captured that uplift in value in your pension scheme, and there is no capital gains tax inside pension. So people like putting land in because they capture the uplift totally tax-free. So it's a fabulous saving if you can put land in and get planning. We have one or two people who do it. So that's worth bearing in mind. But the one we see probably the most of in SAS, and probably what it's really designed for, is commercial property. We do an awful lot of commercial property purchase. And we are starting to see quite an uptick. Mostly because, as you will all know, or hopefully you will know, owning buy-to-let properties is now not very tax efficient, unfortunately, thanks to the Chancellor of the Exchequer, who pulled the rug from under your feet and removed the tax relief on interest payments and so on and so forth. There's a lot of people are now bailing out of the buy-to-let market and the portfolios that they held, because when you work the tax situation out, they're actually now going to make a loss, which is clearly not a great idea. So we are starting to see a shift to people wanting to buy commercial property. And if you buy commercial property through your pension, as you will see in a moment, is a great way of doing it. There is no better way of buying commercial property. I would just say very quickly, because this is a SAS, and SAS is a bit like a limited company, we can borrow money on the pension scheme's behalf. So if you have, for example, £200,000 in your pension scheme, we can go to a bank and we can borrow £100,000. That's quite good for you because the debt will get paid back quicker than any other method. The rent that comes in off the building you own will come in tax-free. If the company that's renting the building is your trading company, the rent is a tax-deductible item in your accounts. So that's pretty good. So because you've got no tax on the rent coming in, clearly you can accelerate the payments on any debt that you may have. The other thing is that the debt on the mortgage, on the SAS is clearly off balance sheet for the company's purposes. So if you want to have a debt-free company, then you use your pension scheme. Clearly any growth on the property is also going to be exempt from tax. There is no capital gains tax. So this is a pretty good argument for putting it in there. But there was a reason why people didn't used to do it, and I'll go into that in a second, and that's gone. So here we go. I'm going to take you through a case study, and I'm really now going to show you why this works from a tax point of view. So I'm going to introduce you to clients, Fred and Wilma. You may have come across them before. They live in Bedrock, which is also called Stoke-on-Trent. And they did what we call a bounce through. We found Fred and Wilma, firm of local accountants that we deal with quite a bit, and Fred and Wilma owned a commercial property personally. And we're looking at them going, you're nuts. Why are you owning this personally? It's just the way they bought it. So they bought a £250,000 property in Stoke-on-Trent, which, trust me, in Stoke-on-Trent is palatial up there. There's a lot of value in the Midlands. So they owned this property, 250. They were renting it to their company. The company was paying them £20,000 in rent a year, on which they were paying £8,000 of tax, and the property was in their estate, of course, for inheritance tax purposes. This is not very efficient. So we said to them, look, why don't you do something clever? Why don't you transfer that property you own personally into your trading company? Good idea, they said. So the accountants, who were going, fantastic, we transferred the property into their trading company. Guess what that did? It created a positive director's loan for them. So they now had a positive DLA, positive director's loan of £250,000. Now, for those of you who are familiar with this, the minute you create a positive DLA, that means the company can pay you back that money without tax on. So we had suddenly created them a £250,000 tax-free reservoir of income in their company. Not bad. Then we said to them, I'll tell you what, why don't we get the company to use that property as a pension contribution to the SAS? Good idea, they said. So we basically transferred the property, and you have to do it in a particular way, I'll just caveat, to the company, to the pension scheme, out of the company. So this is therefore a tax-deductible expense for the company. This is pretty good. So we've now had a double hit on tax savings for these clients. I can't think of a reason why you wouldn't want to do this. What does it look like? That's the tax saving. So the two positive directors' loan accounts saved them £81,250 in equivalent dividend tax. That's at 32.5%. It may vary depending on what tax rate you pay on dividends, but that's the sort of medium rate. So that's tax-free income for till the point, obviously, that DLA is repaid. The contribution by the property into the SAS saved them £47,500 of corporation tax, which actually gives you more money on the balance sheet to pay yourself a dividend because you've paid less to the revenue. Stamp duty was £4,000. You have it twice, going in and out. But hey, who minds paying £4,000 of tax when I've just saved you £124,750? And that's what it works out for most properties. The stamp duty does skew it out at a slightly higher level. But basically, half the value of your property that you own is worth it in tax savings. Pretty good. So we've now moved the property into the pension scheme. Guess what happens to the rent? It comes in gross. They don't have to pay tax on it anymore. So it's saved another £8,000 of tax per annum. Why would you not want to do this? And guess what? The property is now out of their estate for inheritance tax purposes. So if they both went under a bus the day after, we've saved them a further £100,000, potentially. Is this good or is this good? That's how you play with tax. And it's all legitimate. It's all pensions. There's nothing funny about this. So if you have property, use it. Even if it's held in the company, put it in the pension scheme. So, doing quite well so far. Property is now in the SAS. The great thing is we moved this one from them to the company and into the SAS. The great thing was they'd bought it. It didn't have any debt on it, which was nice. Makes it easier. And it hadn't gone up in value. Stoke-on-Trent. Hadn't changed in value, so there was no capital gains tax. So clearly, if you have got a property that you've owned for a while, then you may have to consider CGT. But hey, I think the CGT bill is never likely to exceed the tax savings you're going to make on the other side of the fence. The other advantage you have by putting the property into the pension is that it is now creditor protected as well. So if you own it personally, or if you hold commercial property in your trading company, it is exposed to creditor risk. So if your company goes down the tubes, the creditors to your company, or if you go into bankruptcy, they will seize that property off you. You put it in a pension, providing you haven't done it to avoid creditors, of course, it is outside creditors' grasp. They cannot come and take it off you. And in fact, there was a case in the High Court not so long ago where revenue had tried to suggest to a client, because he obviously owed them a lot of tax, that he should take his tax-free cash and income out of his pension scheme to pay them back. And he argued that he didn't have to, and the High Court agreed with him. That's how strong it is. So there's a lot of case law around this. So it is very strong from a creditor point of view. So an added benefit. And as I said, no inheritance tax, no tax on the rent. So why wouldn't you do it? The advantage of putting the property into SAS is also we can now cascade, and I'm going to show you how we cascade. So why is it so good, and what has changed? There were 2 rule changes in 2015, turned the SAS into the best tax plan ever. And you probably know these rule changes. It's how you interpret them. So it's a pension. You can't access it till you're 55. And as you know, and we're in Islington, and I'm going to say George Osborne is your friend here. It's probably the first time anybody's said that in Islington, I suspect. So you can access the benefits from 55, and you can take out whatever you want now. There are no restrictions. So you can have your tax-free cash if you want it, although I tell people not to take it, because you're amazed how many people take the tax-free cash out and then go and invest it in a taxed investment. Hello? That's not a great idea. Leave it in the pension scheme. So if you don't need the money, leave it in the pension scheme. If you take money from the pension scheme, it must be for frivolous living. Everybody likes having frivolous living for money. So you can access that. And of course, the Daily Mail and all the other papers picked up on this, that everybody was going to take their money out of a pension scheme, and we were all going to rush out and buy Lamborghinis. Seriously, I haven't seen many more Lamborghinis in Stoke than we had before. And there wasn't that many to start with. The really exciting bit was the change to the death. Now, I told you were going to get excited by death today. No restriction on income. I always get ahead of myself. That is one. I put one slide in. If anybody wants the slides, we'll give you copies. If you build up a good pot inside SAS, because each pot eventually works out to each individual, you can control the amount of tax you pay when you take the income out. So if you're really cute when you take the money out, you can use up your personal allowances and pay income tax, obviously, at the basic rate in this example. And effectively, we've got Mr. and Mrs. Smith taking out £50,000 of income and paying an effective rate of 10.8%. Pretty good, because you are being clever and taking the money out in a measured and controlled way, using up your allowances. So you can play. You're in control. So this is the big thing. The only things certain in life are death and taxes. I think we're getting to the point where I'm proving to you that the taxes bit is not a given. So far, we've mitigated corporation tax, income tax, capital gains tax, inheritance tax, and we've given you tax-free growth on the investments. We're doing well so far. The maximum you can hold in pension, as you probably know, is £1 million. So this is the master investor show. This should be the master tax show, because there's no point investing if you're going to give Mr. Revenue Man 20 or 40% of it. So be cute and be sensible and use pensions, and in particular, use SAS. So here's the really exciting bit. Fred, as you remember, was a company director, and he'd saved up and put a lot of money away, properties in, and all the rest of it. So he dies at 74 3/4. Adrian Mole, eat your heart out. The value of Fred's SAS was 850,000, or his part of it was 850, and Wilmer's is 850, just to keep it all fair. What he now does is the trustees look at the letter of wishes. This is our job. So this is where this really gets good. Now, if you've got property in the SAS and you want to pass on the value of your benefits, what changed in 2015 and has really gone under the radar is that you can now leave your SAS money to any beneficiary you like. Prior to April 15, you could only leave your pension scheme to a dependent. If you left it to anybody other than a dependent, there used to be a tax charge on that. It used to be 85%, which was eye-watering. It then got reduced to 55%, and then George Osborne came on his white charger and reduced it to 0. So you can pass on your benefits to your dependents, to your beneficiaries now, without tax. This is really rather good, because that was the impediment to most people putting commercial property in their pension scheme. Because we used to get a scenario where you'd put the trading premises into the pension scheme, dad dies, there's a tax charge on the property, the business has suddenly got to find a lot of tax money because you've put it in pension. It's all gone. There's no restrictions anymore. Load your pension up as freely as you like. So what happens? Well, Fred quite clearly wanted to leave his pension benefits to his wife and children. So what did we do? You have to be a little bit careful because you don't want to leave too much to other beneficiaries who've got big pots. So Wilma's got a big pot, so he would only probably leave her 300,000 or 400,000. But here's the cute bit. The money he leaves to Wilma, because he's died before the age of 75, we pass it over as that she holds it in her pot as a death bequest. Because he died before 75, she can access that money tax-free for the rest of her life. She now won't touch her part of the pension. She will literally draw down on the tax-free benefits. Now here's the even better bit. He will leave money to his 2 children, Pebbles and Barney, I think. So they get a death bequest because they've been made members of the SAS. You can add your children in over the age of 18 anytime you want. So suddenly I have a SAS with the wife and 2 children in. We only allow SASs, by the way, with 2 children because I can only draw 4 boxes. So he passes benefit to them. Guess what they can do? Because it's a death bequest, they can actually access that cash tax-free at any time. They do not have to wait to age 55. How good is this? So if you've got any sense, you get the kids to reinvest the death bequest money and build it up, because potentially by leaving a good amount of money to your children inside the pension fund, you are setting them up for the rest of their life, potentially with tax-free income forever, if you are really clever with this. Now that is pretty good in my opinion. Because he's died and because they are all members of the SAS, it is the SAS, if you remember I said it's an occupational scheme, it's the SAS that owns the assets. So if you have commercial property in the SAS, it is the SAS that owns the asset. So on death, and this is why SASs are so much better than SIPs, the assets don't change. Nothing changes. We just take Fred out, cross him off the list, he's not a member anymore. The other 3 members continue to be members and they continue to retain the assets and the benefits, hopefully, that those assets are producing. There's no need to sell the commercial property. The problem you have with SIPs is they have to be wound up within 2 years of death. This way, we can truly cascade the wealth down the generations. SAS has a lifespan of 125 years. So, because we've also passed the assets inside the SAS box to the wife, to the children, and potentially even the grandchildren, as you will see, you have kept it out of Fred's estate for inheritance tax purposes. There is no danger of leakage, because the problem you have with personal pensions and SIPs is that there is a danger that the widow, who is not going to obviously be in the best frame of mind after her husband's died, making what is a relatively complex decision, what to do with that pension assets on death. This way, you don't have to think about it. It has been taken care of before anybody's died. It works. So this is, SAS is the true, if you remember John Major in the 90s, for those of us who are old enough, said he wanted to cascade the wealth down the generations. This is it. And it's all tax-free. And that's what it looks like. It's very unusual for me to do PowerPoint. I usually draw pictures for everybody, and you have to be engaged. But as you can see, it is actually at one level very simple. You set it up, you make contribution, you invest your money, you take your benefits, and then you die, and you pass the benefits on, and you keep it in the box, and there's no inheritance tax. Key thing with pensions, £10 fine that. The minute you put some money in a pension, it's exempt from inheritance tax from the day you put it in. SAS is the best IHT plan you can lay your hands on, and most people don't realise it. Happy to take any questions if you want. No, we've got time for that. So, see us on stand 33, and they will happily answer any questions. Yeah. Sorry, that was a whistle-stop tour.